In this video, we're going to be performing a deep dive on General Dynamics dividend safety. To begin, let's talk about General Dynamics' business model. General Dynamics is one of the largest aerospace and defense contractors in the world. The company is composed of four business segments: aerospace, defense systems, information systems and technology, and marine systems. The company has a current market capitalization of more than $48 billion, with more than $36 billion in annual revenues. General Dynamics has a compelling track record of dividend growth. With 27 years of consecutive dividend increases, General Dynamics is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. There are just 57 dividend aristocrats in the S&P 500. Looking ahead, investors interested in owning shares of General Dynamics will likely want to know the safety of future dividend payments. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives. 1. Its dividend safety in the context of its current earnings. 2. Its dividend safety in the context of its current free cash flow. 3. Its dividend safety in the context of its recession performance. 4. Its dividend safety in the context of its current debt load. First, let's discuss General Dynamics' dividend safety in the context of the company's current earnings. When General Dynamics announced its full-year financial results on January 30th, the company reported that it generated earnings per share of $11.44 for 2018. For context, General Dynamics paid $3.63 of common share dividends during the same time period for a dividend payout ratio of 32%. Using earnings, General Dynamics' dividend appears very safe with a foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare General Dynamics' current dividend payment to its free cash flow. In 2018, General Dynamics generated $3.1 billion of cash from operating activities and spent $690 million on capital expenditures for free cash flow of $2.41 billion. The company distributed $1.1 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 46%. Using free cash flow, our conclusion is the same as when we used earnings to measure General Dynamics' dividend safety. The company's dividend appears safe for the foreseeable future. Companies do not cut their dividends in good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze General Dynamics' current dividend safety in the context of the company's historical recession performance. We believe the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. General Dynamics' performance during this time period is shown here. While most companies experienced a decline in profitability, General Dynamics saw earnings per share grow 20% from 2007 to 2008 and 1.1% from 2008 to 2009. More importantly, the company's earnings continued to cover its dividend, and it's continued its multi-decade streak of consecutive dividend increases. Accordingly, we have no concerns about the company's ability to pay rising dividends during future economic downturns. The last angle we will use to assess General Dynamics' current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before the company's free cash flow will no longer cover its dividend payment. In 2018, General Dynamics generated $356 million of interest expense and had $12.4 billion of debt outstanding, for a weighted average interest rate of 2.9%. The following image shows how changes to General Dynamics' weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, General Dynamics' weighted average interest rate would need to rise above the 20% level before its dividend would no longer be covered by free cash flow. Accordingly, we believe that General Dynamics' debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on General Dynamics' current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth, visit our website at www.suredividend.com.